But welcome to our Tech Week event. We were thrilled to actually have 1,200 applicants for this event today, and clearly our space could not fit that. So we narrowed it down to the coolest group of people who applied. Most of you are founders and operators. And so our goal today, between Molly and I'll represent seed, Molly will represent pre-seed, is to sort of demystify what's going on in this crazy market of 2023. First I'll give my backgrounds and Molly's background, and then we'll go through the agenda.
Yeah.
That's me. I'm a partner here at First Round in New York. First Round is a generalist seed stage fund. We were actually one of the first to start the category of seed investing almost 20 years ago. We are proud to be first investors in household name companies like Uber, Square, and Roblox. I was a founder in the First Round portfolio before I joined First Round on the investment team almost 8 years ago. We're all generalists at First Round, but I focus on our marketplace investing, consumer investing, healthcare, and climate. And I am joined today by my friend Molly.
That's how good my hair looks when I get it done.
It also looks good today.
Oh, thanks. Super nice to see you guys. Quick poll of the room. So who's a founder? Oh, yeah.
Love that.
Oh, yes. Okay.
Who will be a founder, hopefully, in the next 12 months or so?
Yes.
Yes.
Put that hand high. Okay, I like it. Good. Who's a loud and proud operator? Okay, I see you.
And which VC snuck into the room?
Yeah, who's a VC? Yeah! All right, and last but not least, who's my dorm room fund people? Yeah! Cool. Super nice to meet you guys. I'm Molly Fowler. I'm the GP of Dorm Room Fund. We are really proud to have been backing the best university founders for the last 11 years. We recently spun out of First Round Capital about 2 years ago. With lots of support from the family. I still call this office home after having been on the team for a few years. We invest at the earliest stages of companies' life cycles. So we're cool when you're like, a really, really smart founder with a really great idea and some excellent user development. We also have invested in some household names, things like Brooklinen. We've invested in some public companies like Fiscal Note. We've invested in some up-and-comers like Shield AI. Our thesis is that university campuses are an unfair place to start companies, right? An unfair advantage in terms of access to cutting-edge tech, in terms of access to resources, time, talent, money. So if you're an undergrad, MBA, PhD, or anybody who's dropped out or graduated within like the last year, you're fair game for Dorm Room Fund, and if you're an alumnus of the program. Did I do that?
Yeah, those are the intros.
Okay, awesome.
All right, so here's the rough agenda for today. Dive into some data, then get some opinions. We're calling them frameworks, but they're opinions. Then we're gonna do a pretty quick lightning round, getting hot takes out of each other. And then we're going to save time for Q&A at the end. So we'd really love to hear what questions are on your minds.
Our goal today also is to make this super actionable for you guys. So if there's something we're not covering that you want to cover, please raise your hand, jump in. We're here for you.
We're cool with that. So for the past 2 years or so, we've been hearing about this shifting funding environment. And we have lots of opinions about that, which we will share, but we thought it would be important first to ground the room in some data. So we've pulled some market data with the help of others in the ecosystem, and we're going to share some firm data as well to show you what we see going on. So first, this is data pulled from Carta. This focuses on seed, not pre-seed. We'll get there next. And this starts back in 2020, all the way up to Q3 2023, showing seed round sizes and pre-money valuations over time. Just to talk you through what I see going on here is a pretty steep rise between 2020 and the beginning of 2022 in terms of valuations. You're going from an average of 8 all the way up to close to 15. Then you started hearing, oh no, the market's shifting. And there really was a decline in the pricing of the market overall down to a low point the beginning of this year of just under 12. But you've seen a tick back up in recent quarters. And we'll talk about some reasons why that might be happening. But if I were a founder in the room, I would be feeling pretty good about what we see here because, even the low point around 11.8 is much higher valuation than where we were starting 2020.
Is everybody clear on pre-money versus post-money? How that works? Okay.
All right, cool. And then you might say, okay, that's the market overall. What's happening within a specific firm or at different parts of the seed market? And so this is internal data that I pulled just for you all to show where we've been pricing our investments. We do fully seed. We do rounds that are low as like a $3 million size round all the way up to rounds that are like $6-7 million in size. So that's why you're seeing our valuations on average being higher than what the Carta data shows. And I think the point that is important to take away here is consistency. So it's not like the market shifted and all of a sudden first round said, let's price things low or let's go value shopping. We're still being steady, looking for the best founders, doing the best things out there, and we're pricing it the same way as we were 2 years ago.
Haley, can I ask a question about that quickly?
Yeah, of course.
I think that makes me think about two things. First is, I would say partly this has to do with the fact that this has been first round strategy all along, right? Like you guys really aren't a firm that changes based on the market trends, right? Is that the case?
Totally. I mean, I think in terms of our fund strategy, we've been consistent. We're investing out of our 9th fund. And while the market shifted since we were formed when seed rounds were like $1 million to today, where the average round size we participate in is 4 to 5.
Right.
Our general strategy is the same. We're lead investors. We're looking to take 15% ownership with a check that we write, and we price rounds fairly, which usually means that the founder is taking between 20-25% dilution from the investor money that they're taking.
Got it. And then I guess the other question that I had was like, I think this is also, my hunch is that this is probably driven by the fact that you guys have sick deal flow, right? Like, and so you have the option to like stay steady and just do the best stuff.
So we actually have some data on later slides about, you could be like, okay, this is prices, but how frequently are you investing in this shifting market? Or what's the quality of the deal flow that you're seeing? So we'll get at that too. So now we have the pre-seed valuation data.
Yeah, well, so I wanna, so this is courtesy of our friends at SVB. Shout out to Liz, who's Liz Cahill, our amazing data queen over there. And they pulled some of this from both PitchBook and some of their own internal data. And I wanna caveat this by saying that pre-seed, as you guys know, is a pretty nascent thing, right? It may not seem nascent to us here in the US, or maybe you don't know actually. But outside of the US and Europe, like pre-seed is still not really a thing. The other thing that makes pre-seed really complicated is that pre-seed means a lot of different things to a lot of different people, right? So PitchBook put out this really interesting report that was like, hey, so people don't really agree, so we're gonna do our best to define the category, and here's what we've got. The other thing that makes pre-seed really complicated is that, like, generally speaking, these are companies that are, almost always pre-revenue and usually and sometimes pre-product. And so what I would say is, like, from a data collection perspective, it's like not super, as you guys may have experienced, it's not super easy to go out and Google pre-seed companies, right? They're not, like, there's not a ton of stuff on them out there in the world. However, when we look at the data we do have, I think this is really interesting, right? And because I think you see from, this is considering pre-seed being like basically a sub $1 million, $1 to $1.5 million round that is usually pre-revenue and usually pre-product, right? And it is almost always the first time a founder is taking institutional capital, right? So meaning money that's not just from an angel investor. And so I think this is actually pretty indicative of the dorm room fund experience. I think what's really interesting about this is that it differs like wildly from founder expectations, right? Because I think I can speak from anecdotal experience that this the 4 million may have actually been the case, but in 2021, we were seeing pre-seed valuations at like 10, and again, this is usually happening on a safe, so it's a cap, not a valuation, which is a little bit different, but we were seeing safes with caps of like 10, 12, right? And that sort of became the expectation for some founders. We have had to help founders realize that that is no longer the case, and we have definitely, I would say dorm room funds cap probably sits, like average cap probably sits around this range. I think the other thing is that caps can vary wildly from, whether you're taking money from an accelerator, your cap on your safe can stack over time, right? So unlike a priced round, your pre-seed can have lots of different safes on different caps. And I think you still are seeing in some of the more hypey industries, caps that are a little bit higher than this, but I think that these are really good numbers for pre-seed and like pretty safe numbers for pre-seed founders to anchor around.
All right. Okay, so First Round did a bit of a survey recently. So we reached out to 12 of our peer seed funds, asking them a few questions about what they're experiencing in the market in 2023 compared to the peak of the market. We saw in the Cardid data that the prices haven't really changed. But the first question that we asked is, what about your pace of investing? How many checks are you writing in 2023 compared to 2021? And it's pretty clear that the pace has slowed overall. So 85% of the peer investors in the seed asset class said they've slowed down. And I think this is something that founders are probably experiencing in the market, where sometimes it's hard to tell who's writing checks and how quickly are they leaning in to actually be sending money out the door. Another follow-up question is, how many inbound pitches are you receiving? We call that top of funnel. If you think about it like a sales funnel, at the top is how many opportunities did you see, whether that's referrals, cold emails, however you're sourcing. Because maybe pace has slowed because fewer founders are out there raising. That is kind of not the case. I don't know, it's sort of split. Some of our peer funds said that they're actually seeing more top of funnel. They're seeing more founders come to them in 2023 than in 2021. But another big chunk said that it has decreased. So it's sort of a mixed answer here.
Before you move on here, Hayley, I wanted to jump in. So I think Dorm Room Fund has pretty unique data here because of the population that we invest in, right? So if you think about it, for campus, for campus-based founders, they're more often than not making decisions about when to start a company based on intrinsic variables as opposed to extrinsic variables, right? So things like matriculation date and graduation date, right? Like if I'm a first year at GSB out at Stanford, I'm gonna build when I'm at Stanford, whether or not the interest rate is up or down, right? And so at Dorm Room Fund, we tend to see a relatively steady deal flow. Which has been the case for us in terms of opportunities and companies that we're evaluating. I think a really interesting metric for us is our inbounds, because unlike a lot of funds, Dorm Room Fund has an online application for cold applications. Apply.dormroomfund.com, just in case you're wondering. It's also just at dormroomfund.com. So we've seen that number stay steady. One interesting thing that we did see was that I think different from the rest of the seed universe, we saw a major spike in 2020, right? So when the rest of the world was like, good God, everything's
Zoom
gone to
school
hell.
Is boring. Let
right.
me start a company.
Exactly. We saw all these founders starting cool stuff. So I think, on the one hand, it's kind of not that interesting data that we're steady, but on the other hand, like for us, that makes us really happy and makes our LPs really happy.
Molly, question for you, because pre-seed is basically the pool that we have to draw from to see inbound seed pitches. How are your pre-seed companies thinking about timing the market?
Totally. So I think, I think pre-seed companies, and we're counseling them this way, is that even though, people are different opinions about what the seed market is like right now, we generally see the same thing that you saw on the last slide, which is that it's a longer time to raise for a pre-seed to a seed than we saw before 2021. And so we've been counseling our founders, I think first of all, pre-seed raises got bigger because we were counseling them like the economic environment is weird, raise at least 18 months of runway, and so they were giving themselves more time on purpose. The other thing is that they've been trying to be really thoughtful about when to come out. My expectation is that Q1 of this coming year is going to be kind of wild.
And is that because the businesses are ready for seed, or just because their pre-seeds are dwindling and it's time for more capital?
I think they're ready for seed, honestly. I think like everybody was a lot more thoughtful about making sure they had enough capital, and I think everyone understands, and I think Hayley can probably speak to this too, like the bar is just higher at each of these stages, right? I think that's a thing that's really hard to capture in data, but like, it used to be that if you had $1 million in ARR, you were a Series A, like lights out buy, right? That's become like kind of table stakes, right? Same deal with seed. And so when I counsel dorm room fund founders on how to think about how much to raise for pre-seed, we're actually already thinking about their seed round, right? Like what metrics do they need to hit in order to get to seed? And I think like the bar is higher.
So if another couple quarters help get you more progress to clear that higher bar, then it makes sense to wait.
Yep.
All right, so coming to the end of the data section here. All right, so the deal flow, some funds are seeing less, some funds are seeing more. The next question we asked is like, well, is it good stuff? This is obviously subjective. This is not an objective metric, and this could partly be investor psychology. Right? You're seeing some of your growth stage companies really get pummeled by growth stage markets. You're doing a lot of portfolio company support, so maybe the new deals that you're seeing in your inbox might be the same quality, but you feel differently about them. So
my suspicion is that that's a lot of this.
But look at this big green bar.
Yeah.
50% of investors that we asked said that they actually feel their deal flow quality has improved in recent years. Some other opinions out there too. So that, I think, closes out. Yeah, thoughts on this?
One quick thought on this that I wanted to share. I think like the good news for all of you in the room that are building is that in like funky markets, the tourist founders go home, right? And I know, especially like at the university level, what's been wild to see over the last 5 years is sort of the arms race of capital and resources that have been poured into entrepreneurship education, right? And so we're seeing a boom in who starts companies. The thing is, outside of that ecosystem, I think generally speaking, like if you're hearing that it's hard to raise money, and you've got some cushy job at Stripe, right? You're probably not as inclined to dip to build as you might have been in an up market, right? And so I think for those who are out building, I think my impression at least is that there's a recognition amongst investors that like it's the few, the proud, the bold, and so like I think good for you guys, and take advantage of the fact that there's maybe a little bit more scarcity out there for investors.
Nicely said, Molly. All right, so in this next section, we're going to sort of answer some of the frequently asked questions that we get from founders.
Yep.
And we're going to try to like tease some really good answers out of each other. The first place we're going to start is kind of exploring the differences between what makes someone a pre-seed company getting a 6 post and a seed stage company getting a pre-money at 20. I think sometimes founders are like, should I be raising a pre-seed? Should I be raising a seed? And how do we figure that out? So I'm going to put this slide up here to help ground the discussion. But my first question is for Molly. What is the difference between a pre-seed and seed stage company? Is it the round or is it the company? How do you decide?
It's totally the company, right? And I try to explain this to founders all the time because I think one thing that, and we'll talk a little bit more about this in a bit, but like you really want to match the maturity of your business to the round, right? And I think each round has a really different role to play. I might skew a little bit conservative, but that's because I think we all learned from the 2021 bubble, right? And so like you really don't want to get out over your skis in terms of your valuation and what people are expecting from the maturity of your business, right? So I think the way I think about it, and again, we've entered the opinion section of this conversation, is that your pre-seed round should really be about de-risking, right? I want you to come to me when you're a pre-seed founder with a really unique, unfair, like earned insight, right? So like, it's not just like, hey, I really want to build in this space. It's like I've gone out and I've learned something from my lived experience, from my last job, from people around me, from some research I've done, whatever it is, that I think is different and that no one else is seeing. And I've gone out and I've done the work that I can as swiftly and as like scrappily and as cheaply as I can to prove that there's interest from customers, right? Whoever my customer is. And so one of the things that we look for is, you know, a founder that's gone out and like done a shitload of user research, right? And you can do a lot of stuff basically for free, right? And so one of the things I'm always excited about is founders that have done a lot of work before they come to me, and they come to me and say, I'm raising this pre-seed round so that I can unlock the following, like bang, 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 and bang, that I couldn't have done without capital, right? So usually that means that there's a pretty good sense of what the product looks like. We've built out the Figma, right? Like we've recruited the co-founding team. We've done a bunch of user research. We've learned some things that we didn't expect. And now we just need a little extra help to like build out the MVP, right? Or we've gotten to MVP already, me and my co-founder, and I just need a little bit of extra help to move as quickly as possible so that I can service my design partners that I'm working with, right? And so I think when you, like, magic for an investor is when you come to us and say, like, there's urgency for this capital, right?
But it also sounds like that a like small shot of capital can seriously get them to new insights.
Totally.
Or to an inflection point
Totally.
of some sort.
Right.
And ideally that's directed in sort of like one direction.
Yes.
Instead of five.
That's right.
Because there's been some de-risking done in the user research
Totally.
or the exploration phase.
Exactly. And I would say there's also probably de-risking that is going to happen again once you raise the pre-seed capital, right?
Yeah.
So like, ideally, when I'm handing off a dorm room fund founder to Hayley to first round for seed, maybe they've used that pre-seed capital. They narrowed the 5 pathways to 2, and they ran a shitload of really targeted research and testing against those 2 pathways, and they find major signs of market pull, right?
Yeah. That's so I'd love to pick up from there and explain sort of like what we see as seed.
Totally.
Because I think it can be confusing. Sometimes first round is investing before there's a product.
Yep.
We're often investing before there's revenue. And so you could say, okay, if there's no revenue, why is that a seed stage company instead of pre-seed company? Yep. And I think the way that we think about it is where that company is in proving out product market fit. And at the seed stage, there's some interesting signals that there's real fit between what you're selling and what your customer wants. Sometimes that is revenue. Really great to have delighted customers willing to pay.
Yep.
Sometimes that's design partners.
Right.
But sometimes that is still in user research or a prototype. But the lens that we use for it is that we really understand that if you get that $3 or $5 million round, you should be building a company.
Yeah.
Because there is early signs of product market fit. And always happy to unpack this offline or one-on-one with founders, but I think that's the difference.
Yeah, and I think like just for contrast purposes, Hayley, like I don't know what you think, but the way I think about it is that like pre-seed's for discovery and acceleration. Seed is when you've got signs of product market fit, and then A is when you're ready to like
pour gas on the fire.
And repeat. Yeah, like
you've built an engine that you know where to point it towards.
Yeah.
All right, so we've got this slide up.
Yeah.
This is pretty basic, but this is the rough categories that most investors use to evaluate any opportunity. You're evaluating a team, the market they're going after, the product they're building, and of course, terms are important. And I thought we could talk a little bit about how you weight these categories or how your investing team weights these categories at the pre-seed compared to how first round weights these categories.
Yeah, and I'm hoping I'm doing this right for all of my investors.
They could feel anyone who's a
Zach,
dormant fund investor can
but
correct Molly if she gets it wrong.
Exactly. But I would say, so from my perspective, I think at pre-seed, what we're really looking for is a kick-ass founder there's really good founder market fit, right? So again, like I said, the thing that separates the wheat from the chaff for us is that earned insight, right? That like it's something different. You're not the 15th version of this AI wrapper that, that I've seen in the last 2 weeks, right? Like you've seen something about the world that no one else has seen, and you have personal lived experience that helps you execute in that market, right? And so it doesn't, what's interesting is people are always like, oh, well, you invest in like MBAs, but also undergrads. Like, how do you find that in undergrads? You guys would be really surprised, right? It doesn't have to be like I worked in this industry. It can be like I'm obsessed with this problem, and like I dropped out of Harvard for a year and went and became the youngest, funeral director in the history of California because I want to build in death tech, like actually
Fun.
a thing that happens, right? Or
I think I talked to that guy.
yeah, yeah, he's amazing. But it can be, I grew up a Japanese American kid, and like I learned about this ancient art of fish slaughtering that
You're really morbid today.
I know. I'm just talking about my favorite weirdos, like at Dormer Fund. My favorite people are like weirdos, smart weirdos. But and so like he's now building this crazy AI robotics company that's gonna change the commercial fishing industry, right? Or like my mom's a realtor, right? This is a company we met recently, and I've seen how inefficient her workflow is, and so I'm gonna build this AI tool that's gonna completely redo her work experience, right?
Love that.
So that's the kind of thing we look for. So I think founder market fit. I think the other thing we're really looking for is big market, right? Like how does this either get into what is already a big market or create a brand new big market, right? And there's sort of the iconic like Uber story that we can tell there. The last thing I would say is like at product, to be quite frank, like we expect your product to morph at pre-seed, right? We want to see how you're building your product, and we want to see those unique insights, but my guess is that your product is going to look really different by the time I introduce you to the first round team, right? So I would say like heavier on team and market at pre-seed, and terms. I mean, like, a lot of pre-seed investors are prevented from investing at a certain cap because it just doesn't make sense for their model. And so if you're raising at a certain valuation, it's going to be kicked up to the seed crowd.
Cool. Yeah, I think, honestly, I don't know if our weighting would be that different.
Yeah.
It's probably just what we're looking for within each of these buckets is a little bit different.
Right, more advanced. I always describe it to founders as like, it's like if you've got a kid that you're sending to kindergarten, right? If you've got like a cusper kid, it's like if you have this like little scrawny kid, like maybe you want to hold them back and like send them to pre-K, But like if you've got like a bruiser and they're like on the older edge of the class, like send them to kindergarten.
And how many of your founders are like, I'm scrawny?
I mean, no one wants to be scrawny, but you know what I mean. Like give yourself the extra year to learn how to read, Like.
All right. So do you want to dive deeper into any of these categories?
No, I think we covered the. Do you guys have any questions on any of this stuff? We can come back to it a bit.
Oh, yeah.
Oh, okay. Clarification in the back. Yes.
Like we have to interrupt these ladies there.
Or just a totally different question?
If it's a totally different question, we'll hold it till the end.
Okay.
If it's about this topic.
It's about pre-seed, but I'll hold it.
Okay. Jean-Claude.
I think we'll often have founders come to us initially trying to raise.
Jean-Claude Dorsamville, former Dorm Room Fund alum, seed investor at XYZ.
So we do pre-seed and seed, and we'll sometimes have folks come to us and say, hey, I want to raise a $5 million seed.
Yeah.
And it's just clear that that's too big, too early.
Yeah.
How do you encourage founders to take that sort of feedback and pivot to raising something smaller without it feeling like you're flip-flopping between, oh, I'm going to raise $1.5 million as a pre-seed, but I originally wanted to raise $5 million.
Yeah.
And have that be a clear, cohesive story that comes from a position of strength, power versus like, I don't quite know what I need to be doing at this time.
Great question. I feel like I could take that because
Yeah.
I'm more likely to get the $5 million rounds where I'm like,
I get it too, but yeah.
It's tough to change a founder that asks for $5 million and convince them, first of all, that they should partner with you, but also you want to give them half the money that they asked for. So my counsel to founders really is always start smaller. It's way better to interact with an investor, give them the pitch, say that you could get really far with a smaller amount of money, and have them say, but what could you do with more?
Right. Totally.
So like, I think if you're unclear what you should raise, put a range on it. So like, don't say 5, maybe say like 3 to 5, here's the plan if we do 3, here's the plan if we do 5, and you're just better positioned to be able to move that forward in that conversation. Otherwise, if the founder comes to me saying 5, I probably say it's too early for us. There's things you need to de-risk, and maybe I leave the door open, but most likely they're just getting that market feedback, and then have to go to a totally new set of investors having learned their lesson, and unfortunately probably burns their favorite investors that they really did want to work with.
Yeah, I agree with that wholeheartedly. I've seen this happen a lot where founders get happy ears. Because some founder friend of theirs is like, yo, you should totally raise it like a 25, And it's like, and you can actually box yourself out of the best investors by doing that. And so I think this actually pivots nicely into the next thing we wanted to talk about, which was like, how do we, what mistakes are founders making, right? And what are we so how are we helping them solve those mistakes, right? And I think the thing that we to answer Jean-Claude's question and sort of to talk about I think one of the things that first-time founders often see, or and one of the ways that I think Dorm Room Fund can be most helpful, and that I think Caroline and I provide really tactical support. Caroline, wave. Is a lot of first-time founders don't know how to fundraise, right? And so to Jean-Claude's point, they
no one is born knowing how to fundraise.
Yeah.
Let's just get that out of the way. Don't be embarrassed if you're how do I do this?
Yeah, totally. And they're
maybe they teach it in school now, but I don't think they do.
Not most schools. Yeah. And I think even when they do, it's a little bit. But the number one thing that I do with first-time founders to help them avoid a lot of these mistakes, like the one you're talking about, which is overpricing themselves, is that we try to give them frameworks to think about how much to raise, how to leverage their ecosystem to get to and then how to set up all the details that you need in advance of starting your raise, and what resources you need. And then how to gut check to make sure that you're in the right realm, right? And so one of the things that we always talk about is sitting down and thinking each raise. Once you get on the venture hamster wheel, you can't really get off, right? And so I think one important thing, it's very uncommon for people to raise venture and then stop, right? And so I think ultimately in the back of your mind as a founder, you should be thinking about how do I set myself up for the metrics that I'm going to need at the next round, right? And not go out and burn these relationships because I'm investing, I'm asking for too much, right? And so the exercise we have founders do is a bottoms-up analysis and a top-down analysis, right? So bottoms-up is go out, research your peer companies. What are they posting in their TechCrunch announcement articles, right, when they raised their seed or their A or whatever round you're at? And think to yourself, okay, what are the product milestones and sales milestones that I'm going to need to get to in order to have parity that I'm seeing at this next stage, right? And you can kind of, in a nice way, back out from there to think about what resources do I need, what people do I need, how long is it going to take, and then you can kind of calculate burn, right? Give yourself a little bit of a cushion because stuff always takes longer than you think it's going to. And then that should give you a general sense of how much capital you need, right? You might create an up version of that, to Hayley's point, so that if an investor asks you okay, you're raising 1.5, what could you do with 2.5? And it's yo, we could do this, right? But I think, and then the top-down version is once you have that number, go out and compare it and do a little research amongst your founder friends, go on PitchBook, go on Crunchbase, is that number sort of passing the sniff test, right? Or are you going to end up in crazy loony land where you're trying to raise a 50 post for your pre-seed?
Getting feedback so important.
Yeah.
All right, I'm going to speed us through a few things because I have a sense we have a lot of Q&A.
Yeah, sorry, I'm so chatty.
So we've been talking about the market like it's a monolith, that a pre-seed is a pre-seed, a seed is a seed. And I think one of the real stories behind what we saw in the data, that prices have stayed the same, but volume has gone down in terms of the pace that seed firms are investing at, has to do with the fact that there's kind of a tale of two markets right now. If you think about this thermometer, this is not data-driven, this is sort of directional. There's a few sectors today that investors are leaning into and very excited to invest behind. And there's a few that have significant tailwinds that investors have really pulled back from. And it's important as a founder to understand where you are on this thermometer. What should you do if you're a founder that sees yourself on the bottom? Don't panic. Don't slap some AI thing into your pitch. That won't do it. But I think what you have to understand is why have investors cooled in this category? What's going on with the public market companies in your category? Why are they trading down? What have been the mistakes? How can you sort of defend against those in your business plan? How can you address them head on in your pitch? And then the other thing that we've found with our seed stage companies going to raise Series A's in these sectors is that they need to be, I guess, more creative about building out their investor list and looking for sector-specific investors. Because even if the category is cooled, there are still consumer-focused funds. There are still healthcare-focused funds. There are still fintech-focused funds. Maybe don't waste your time on generalist firms who could sort of like bend and weave to go to the hot categories when they're hot, and instead find the people who truly believe and truly understand your category deeply.
Yeah.
All right, we're gonna do our quick round and then we're gonna get to the Q&A.
Yeah.
Tweet length answer.
Yeah.
Generative AI, feelings.
I rip off all my best opinions from dorm room alumni.
Excuse me.
So Lauren Reeder, who's a DRF alum, who's a partner at Sequoia, put out this great piece that I thought was genius. And her perspective is, and that I've adopted, is that the big LLMs and the big sort of machines that are powering a lot of the AI-driven, innovation that we're seeing are going to become part of your stack. They're going to be sort of commoditized the way that cloud infrastructure is, right? Like, so same way you use AWS, you might be using, GPT. So the thing we're looking for is companies that, like, again, have like a really unique insight and like some defensibility even in the product that they're building on top of the commoditized thing.
Awesome. Yeah, I think at First Round, we are so excited about the transformative nature of the latest advances in AI.
Yeah.
In terms of where the value will be captured, that's a bigger open question for us, because in many ways this feels like a sustaining innovation instead of a disruptive one. When we look at investing at AI companies at the seed stage, we're really focused on some of like the picks and shovels for the AI revolution. And we're also thinking about data advantages as well as distribution advantages in terms of where we place our capital. All right, this is like a pre-CD question.
Yeah.
Accelerators, yes or no?
This so depends. Look, I think like it's really expensive capital. I think it can be transformative if you get a really great team that is running the accelerator. I think if you're doing it for clout, that's a terrible idea. I generally think doing anything as a founder for clout is a terrible idea. So yeah, depends. Make sure you really press on what the value is, because it is definitely the most expensive capital you can take.
Cold emailing investors.
You and I were talking about this earlier. If it's the only way in, go for it, right? And I think some funds have mechanisms for that. Like Dorm Room Fund has our online application specifically because we want to see cold applications. But I will say the best thing you can do is activate your existing network to help you get warm intros, because it makes a huge difference. And think broadly about who your network is. Your angel investors, your founder friends, your former professors, your former colleagues. Like we have this spreadsheet that we use where it's like put all of your dream investors on the list and then have a column and send it out to a bunch of people that you know, and they can assign themselves if they've got a strong relationship with those people.
Great
What about
tool.
you?
I agree with you. It's like, it wouldn't be my first choice for a founder to just cold email all investors. You should do what Molly's talking about. But fun fact, First Round has invested in founders that have cold emailed us. Actually, one of our best performing companies in our last fund was through a cold email. You just have to be creative and thoughtful. We probably won't respond if it's very clear that this is an email blast to 100 investors where nothing was personalized. But we will respond if there's something that shows that there's thought put into the outreach.
Hot tip, Chris Fralick, who's a board partner here at First Round, wrote an article at Forbes like a decade ago about how to send a really good email. It is gold. Google it. Use it. You're welcome.
Any questions for me?
Yeah. Sorry, Hayley. So actually, this is a hot take for you because I know I'm really curious. Co-CEOs.
Oh, So I was a co-CEO back in the day, and it worked really well until it didn't. So when founders come to me with pitch decks that don't have titles, which, by the way, investors know if you're not putting CEO next to someone's name, we're worried that maybe there's no CEO. I ask them, what are your titles? What are your functional responsibilities? There needs to be a really clear breakdown. And I think even if you're not ready for one person to be CEO now, I think you should have an answer for if you were forced, who would it be and why?
Yeah.
I have a company that is at like a Series D stage. They're performing so well. They don't use titles between the two co-founders. They're co-founders, but in the boardroom, we know who is CEO, and I think that's a good way to solve for it.
That's awesome. Memos instead of pitch decks.
Look, I prefer a pitch deck. Investors' brains receive information through slides. It's the best way to structure a conversation over 30, 45 minutes. If you want to follow up with a memo, that's great. It helps when we start digging into diligence. But I think there's something that sort of like has me do a double take when I have to prepare for a meeting, then have to read 10 pages instead of flip through 15 slides. So I think, both is probably.
Yeah.
Yeah.
To me, it indicates the inability to like distill your points.
Can I just ask a follow-up on that?
Yeah.
What's your guidance for founders in prepping diligence before they go out and start raising their rounds?
That depends on the stage. I think you've got to prepare, you've got to do practice pitches, you have to think about what the frequently asked questions are. I actually love when founders start building a FAQ doc internally, so they know, okay, everyone keeps on asking me about addressable market. Let me have like a really tight 3-sentence answer for that.
It's also my favorite power move when there's a question you always get asked and you have a pre-done slide for it and you're like, oh, funny, you should ask.
Yeah, let me flip to page 52 in the appendix.
Yeah.
And then there's like another thing called a data room, which can be helpful as you get deeper in diligence. But again, I sort of think there's this information overload that can happen if you dump it on an investor too soon. And that it's sort of better to make it a conversation and be like, what are your top 3 questions? Let me get you really thoughtful answers just to those. Instead of being like, cool, nice to meet you. If you like it, here's my data room. Like, I don't know where to look and how much time I want to spend digging through that. So that's my take.
All right, two more quick ones, and then we're going to move on to questions full time. In person or Zoom?
Honestly, both could work. I think, frankly, it's first meetings work better for founders. You guys could agree or disagree with me, but I just feel like if you're doing a high volume of first meetings, it's tough to schlep around the city trying to meet everyone face to face. But we love to meet founders in person when we're digging deeper and getting to know the business and the person. And that said, it's not necessary. But look, on your side, when you're fundraising, you really want to get to know the people in the firm that you're taking money from. So even if it's logistically easier just to do everything over Zoom, it might be in your interest to spend time in person as well.
All right, last one, and this is a really spicy one.
Okay.
How do you feel about founders that spend time with investors before they're fundraising?
Ooh, I mean, sure. In terms of like when founders reach out and they're like, hey, can we hang? I'm like, I'm really busy. I've got 10 deals that I need to focus on now. You need to give me a reason that you want to get to know me. Like, is there something you want input on? Like, it could be frustrating if there's not a clear ask.
Yeah.
What I tell my founders who are seed stage and thinking about how to build relationships with Series A investors, I tell them, look, it's best to do that way before you need to fundraise. You have to be super careful about what data you share because that investor is going to remember. They're going to look back saying, where were you when we had coffee in September and how far have you gotten now that it's February? And they're also going to remember what you said you were going to do. So if you say you're going to have this many new customers or you're going to launch a new vertical or XYZ, you better do that and then some. So great to get to know people, get them to know you, especially in a crowded category, because then they could be like, oh, wow, I'm interested in this category. Molly seems like the one I might want to place a bet on. I'm going to make sure she doesn't fundraise without me knowing. But you just have to make sure you don't hit any of those tripwires in terms of disappointing when you come back for the fundraise.
Totally. Good advice. All right. Do you want to wrap up, do our takeaways, or should we do a few questions?
Let's do questions, and then we can do our takeaways at the end. How
All
about
right.
that?
Sounds good.
You
All
can,
right.
You can be MC.
Sweet. All right, madam, what is your question?
So you talked about the difference between pre-seed and seed. I wonder if you could talk a little about the difference between angels and pre-seed. Because I know a number of people, maybe this is again the founder friend story, who just went straight to pre-seed and didn't raise angel money, and that seemed like they didn't really have much
Yep.
when they did that. So I'm wondering to myself, like, do I need to do this, first I do this type of money, then this type of money, then this type of money, or
Yeah.
if I know a pre-seed fund and they're interested, just go straight there.
I think you can go straight to a pre-seed fund if you're ready. Like, I think angels are sometimes nice because, look, humans are humans and social proof is nice, right? Even though the best investors ideally are not momentum investing based on other people's opinions, right? But sometimes people will have angels that come in earlier because they have strategic value, right? So they're a really seasoned operator in your space, or they're an expert at sales and you're new to the sales side. So like that's a place where I would think about bringing in angels early. More and more what I'm seeing is that pre-seed and then like the quote unquote formerly known as like friends and family round, which I think is the dumbest phrase because I don't know about you guys, but I don't have friends and family that are writing me $50,000 checks. But like, I now think of those two things together as often like the angel round, right? And I think that's like, I think as long as you're being really strategic about who you're bringing on at those early days, right? Because again, it's the most expensive capital you're ever going to give away in terms of equity, right? And like making sure that each person you're bringing around the table is really delivering a specific value. I really don't think it matters, and like I don't think it's as stepwise as people might make it seem. Good question. Do you agree?
Totally. Yeah, I think you like there's no checkbox you have to have like angels first, then pre-seed funds. What I see most often is that like you talk to individuals as practice, some of them might get excited and commit to what then rolls into the pre-seed round. Because it ends up being a pre-seed fund of some sort that prices it and the angel checks come in alongside. But if a pre-seed fund's leaning in and they're like, we like you, we like the idea, here's the round we're thinking of, you could be like, cool, can we leave room for angels? Can you help introduce me to some really awesome operators who could be good connections or good mentors? Like you could do it that way.
I'm really glad you brought up the angels as practice. One other thing I think is useful for you guys. A big mistake that first-time founders make is that they'll go straight to their dream investor first. And that is a terrible idea, right? Because you haven't had a chance to really hone your pitch yet, right? And so generally speaking at Dorm Room Fund, we recommend a 2-1-3 strategy, right? So like
Got all these like clever names. I
told
can't wait
you.
to hear this. What's 2-1-3?
All right, so you take all your dream investors in your spreadsheet, you label them tier 1, like reach school. Like, oh my God, my life is made if I get a check from First Round Capital, right? Tier 1. Tier 2 is like really great. This is like, I always use college metaphors. Tier 2 is like really great small liberal arts college that you really want to get into, right? Like you'd be like, I would be amped.
Some people, that's their tier 1.
Some
It's
people, that's their
subjective.
tier 1, right? Dorm room funders make me skewed because they're so smart. So like, tier 2 is like, I would be so amped to be at this school, but it's not like my reach. Mm-hmm. Tier 3 is your safety schools, right? They're awesome. They've got a lot to add. I would have a great time, but like maybe it's a little less competitive, right? And so what we recommend is you tier all of your investors. You start with 2 because it's important. They're going to ask really good questions and you can get your sort of willies out. Then you get tier 1 when you're sort of practiced and honed, but you're still giving the tier 1s enough time to do diligence, because one thing that tier 1s hate is when they get boxed out of having enough time to do diligence. And then tier 3s you do last, because you're sort of slightly disadvantaging them on the diligence front. But what's nice is that hopefully maybe you're bringing some interest from the tier 2s by the time you get to the tier 1s, and then you can ideally parallel track a lot of this so that you can get multiple term sheets at once.
Love it. Cosign.
Yes.
Hey, I'm Shane at Bowery, which is decidedly later than pre-seed and seed. But my question is around what happens after the check and what's changed in this market for your time especially as it relates to the attention needed to the growth stage companies who are going through challenging times?
Okay, I'll answer the first part of the question, and then maybe we could do the growth stage company thing after. Okay, so first it's term sheet, then it's diligence. The lawyers do a lot of work. Money gets wired. What happens next?
Founders, spike the football!
I like, when the money's wired, sometimes I tell my founders, like, take a screenshot, light a candle, set your intentions, now get to work.
Yeah.
Celebrate, but it's like a means to an end.
Yeah,
Like a fundraise is not.
Real work starts now.
Yeah. So it depends on the fund, but I think one of the most important conversations to have after the money's in the bank is to say, where are we aiming this ship? Where do we need to get in 12 to 18 months in order to unlock the next round of funding? And let's make sure we're agreed on what those metrics are. Should it be totally focused on revenue growth, or instead should we be focused on product R&D milestones? And having that conversation comfortably early, getting alignment, and then setting the long-term plan. Then conversation number 2 is like, all right, there's the plan. Who do we need to hire? Money's in the bank. Everyone's like, finally, I could stop doing 12 jobs myself. And we help companies get the right early employees on board. The last part of your question was about growth stage companies. Maybe you can give me a little bit more on what you want to hear there.
The question is, like, are you finding yourself spending more time helping growth stage companies, and is that slowing down the attention and focus to pre-seed and seed and support in this new environment?
Yeah, I think that the answer is yes, because what happened to growth stage companies in this cohort is that they were raised in an environment of growth at all costs.
Yeah.
And they built their plans, their teams, their products around that.
Yeah.
And then the music stopped, and they were told, nope, turn the wheel, look at your burn, look at your efficiency of your growth. There might not be any more capital for you ever. Figure that out. And so most of those conversations were had last year, where we were like, we think this is a big shift. We think you need to understand this. Let's totally rip up whatever plan we had to have a much more efficient one.
And you guys put together an awesome deck for your founders on that front.
There was decks, there was one-on-one conversations. Some founders get it immediately. They're running ahead of us making those challenges. Other founders were like, you really need to do this now. You really need to do this now. And that continues. I think it's just tough that the sort of goalpost changed for that cohort. But look, our model as early investors is that we're not the only ones around the table helping the Series D companies.
Yeah.
They've added their Series A board member, Series B board member, Series C board member, who only invest in 1 or 2 companies a year, and they are fully focused. We end up as seed investors sort of just being the emotional coach in the corner.
Yeah.
Being like,
We're like your best friend from undergrad who you call when you have a bad day.
we're like, yes, this is so shitty. I'm so sorry. Yes, you have to listen to the person who wrote that $100 million check into your company in 2021. That's the size of our whole fund.
Right. Yeah.
So the answer is yes, but it's also, we are set up to find the next great companies too. We are super focused on doing that, and it's sort of the later stage investors who are doing most of the day-to-day.
One thing I will add to that that's I think unique to Dorm Room Fund is that because of our model and our student teams, we graduate about 30 future venture and founder professionals every year into the ecosystem. And so what's cool is that now that we're 10 years into it, a lot of those alums have become very senior people at some of the best funds of the world, right? So we've got partners at Sequoia and Bessemer and Andreessen and Excel and Upfront, and we just had one named, So long story short is what's really fun for us now is that yes, Caroline and I are going to focus our time on those early stage folks that are in our portfolio, but we have now this really amazing network of people who we can reach out to and say, hey, I know that this dorm room fund company is about to raise their A and they're sick and you should meet them. And so that's been a way for us to actually leverage our community to start to help the folks that are a little bit farther downstream.
That's awesome. I think we should take 2 more questions. So make sure they're really good. And
All
you
right,
can pick who.
Whale, because you have a sick name. Is it Wale?
Yeah, it's Wale.
All right. It's also sick.
Thank you. I appreciate it. So you spoke about seed stage companies being pre-product and even pre-revenue, but having signs of product market fit.
Yeah.
Is that something that needs to like have happened over a period of time, or can like recent developments, whether it be design partners or some sort of breakthrough moment in terms of like just gaining more traction, be substantial enough
Totally.
to
Yeah.
raise the seed round?
Yeah. I actually think that investors love when it's like the last 3 to 6 months, you can't believe how strong the signals have been.
Yeah.
And that's actually better than like, I've been working on this for a decade. And only now do I have signs of product market fit. Like that, we're worried. We're like, what have you been doing for a decade? Do you have enough urgency?
Yeah.
So I think as long as the signs are there, and like momentum is the key to any fundraise. And so it's less about the absolute number and more about the slope of the line. And again, the line doesn't have to be revenue. It could be design partners that are reaching out, and you just got referred one by your first one, and like the train's leaving the station.
Got it. Thank you.
Good question. Okay. Black shirt. Yes.
I just have a question on like the fundraising frameworks and the terms piece. Like,
Yeah.
Aside from valuation, is there anything like nefarious you should look out for in terms like thing I'm unprepared for is to like read and evaluate. I'm not a lawyer, so how do you evaluate
Good
a term sheet
question.
besides the like headline number?
Good question. So first, get yourself a lawyer who does venture deals.
I mean, it's like the number one thing I do for our founders when they first
And we
call
have,
me.
we could give you a list of 3 to 5 names of New York-based lawyers who
Us
we
too.
respect at Dorm Room Fund in first rounds.
Yeah.
There are price terms in any term sheet, and there are non-price terms, and those are things like what the board construction looks like or what investor rights are. And the goal is just clean and market. You don't want your investors doing something that's non-standard. And I also suggest as founders, you don't ask for something that's non-standard. Like you might think you're the next Zuckerberg and you should have 100-to-1 founder voting rights, but like, no, later. You learn that later. But I think for us, when we invest, terms are the last thing we think about. First, do we want to partner with this person? Is this company going to be huge? And we'll figure out the terms to make it work after the fact.
I agree. I think it's especially important at pre-seed because I think some angel investors invest in a vacuum, and so they don't know what market is. And so they, whether on purpose or not, will ask for wacky shit. So I think thinking about your attorney as a business partner is really important. And one of the cool things about having an attorney or an institutional investor is that they've done enough reps that they know what market is. And so like, don't be afraid to reach out and be like to like people that are already on your cap table and be like, does this make sense? The other thing.
Did we let any lawyers in today?
Yeah, we love you.
They all wanted to come. I got so many emails because they knew they want to work with you.
Yeah.
So go find him afterwards to ask questions.
And then if I leave you guys with one thing today, well, 2 things. One, absolutely do not let anyone take a board seat at pre-seed. That shit is insane. Secondly,
Except yourself.
Except yourself. Yeah. Secondly, back channel your investors. Call your friends. Ask the investors for references. Ask them for people that worked and it didn't work. Because to Hayley's point, like terms are almost last, right? You want to make sure you're working with the best people, and it's a long relationship. And so before it's like, it's kind of like the game shows like Married at First Date or whatever. And it's like, make sure you're going to be like down to like raise kids with this person,
All right. So I think that brings us to the end. Those were some awesome closing thoughts. I think I'll just share, like, look, the market is different, but I think in many ways it's healthy and clarifying for the focus to be more on building companies that are sustainable with great unit economics. And even if you're in the categories that aren't hot right now, you can raise. You just need to understand what you need to prove in order to unlock that capital. Both Molly and I are happy to spend time with any of you. Send us an email. We would love to hear what you're working on. I think we could probably email everyone just our email addresses after this. And we look forward to hearing from you. feel free to hang out. We still got coffee and food, and you all should get to know each other and share your experiences.
Yeah.
Thank you for coming today.
This is your cohort. This is your family.